Another RBA rate cut. Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of Heise Says. Still doing my stein of coffee this morning when I thought we would have a look at this article from the ABC discussing the impending rate cut. There's predictions of another interest rate cut because 1% is not low enough, and the economy's doing fine, guys, fine. They're just doing this just to see what will happen. I'm sure of it. I'm absolutely certain of it. So just how much of the RBA rate cut will end up in your pocket? So guys, if you like this type of content and you think it's valuable for your friends and family to see an alternative perspective, just the take on this, kind of trying to stitch these different pieces of information together, please share these videos and share this channel with your friends and family on social media. At the very least, start a discussion. People can start thinking about what's being put forward to them. And this morning we looked at two conflicting pieces from the same paper about the real estate boom, the real estate recovery that's apparently happening. So the big question on interest rates is not when or even will the RBA cut. It is how much will the banks pass on. So what I'm going to do is we'll just jump over here to one of my favorite websites, which is Trading Economics, and let's have a look at Australia. And we have here our interest rates, and we can see the changes from just 2016, boom, down. So whenever you see any positive news in the economy, you need to think about how drastic an action the Reserve Bank has implemented to getting down to this percent, 1%. Let's look at the max data. It's never been this low. It's insane. So they've got very little capacity to move. Last time we had a recession, you generally want, I think, between 5 to 6%. They want to cut to stimulate the economy, because this is the mechanism that this economic theory is pretty much embedded on. It's they manipulate the money supply in the economy, and they also ignore the whole role banks play in creating money out of thin air, and how that will affect your inflation. Those things don't matter. But so they've cut it that much. That's been a significant change. And then we're seeing, sure, there is improved demand for real estate. People have increased capacity to borrow, but that's also to do with APRA rules. But when you put this all together, all the spin and hype that we're getting there from the politicians and from the media, it doesn't fill you with that much confidence when you see the drastic actions that they've taken. And sometimes it can all, this cut can get lost in the noise. Let's look at, this is the max data. It can get lost in the noise because you're bombarded with so much info. So let's get back to this article. The RBA cut is a no-brainer. It is pretty well a certainty in the next couple of months. And the old saying goes, official interest rates move like cockroaches. When you see one, there's always another nearby. The market has priced in 2 full 0.25 percentage points by May next year. When is a bit trickier. This week's RBA board meeting on Tuesday is the popular bet. So guys, if you have a mortgage and you're waiting to hear on this RBA cut on Tuesday, how do you respond? Do you contact your bank and insist that they give you a cut? Do you look at other options? I've got relationships with brokers that I'm trying to, would you be interested in hearing some, takes from some different brokers and suggestions? Because now's the time, if you can, to refinance to secure a lower interest rate, or at least to have some information to put to your bank and have a negotiating position. Remember, if you have the power to walk away, if you say, I've got this other option from this other bank, here's the stuff the brokers put to me, what can you do for me? Can you match it, or can you better it, or I'll walk away? That's really powerful. The power to say no and the power to walk away is the best negotiating strategy you can have. It seems to be something the UK British Parliament doesn't seem to understand with regards to Brexit, but they want to sabotage it anyway, don't they? The will of the people isn't important anymore. Bookies would be offering just $1.25 excluding the commission in a 2-horse race between a cut and a hold. In other words, a short-priced but not unbackable favourite. The question, how much will be passed on, is a lot more problematic. The calculation has a vast array of variables. Politics and high court of public opinion, bank balance sheets, funding costs, competition for new loans, shareholders' dividends, and regulatory interests are all impinging on the outcome. The RBA's June and July rate cut saw the big four banks pass on between 80 to 90% of the aggregated 0.5 percentage point cut. Notably, ANZ quickly changed tact and handed out the full cut in July after being hammered for its stingy effort in June. You can bet it won't be the first out of the starting gate this time. Across the big four, for a $400,000 loan, the combined rate cuts deliver a savings of around $1,200 a year. So, I mean, is this going to... Two things are going to happen. It's going to encourage more people, or give more people the capacity to borrow more money. And there's the hope that doing that will get them into houses, and then they'll have to fill the houses full of stuff, and they'll go spend it. Also, the hope is that this will keep people in their homes longer, so they won't have to sell, or that they will spend the money. That they will spend it. So June rate cut, July rate cut total. So CBA, Westpac, NAB, and ANZ, because this is it. You know, this is our big four banks, all too big to fail. Yes, sure. So not so generous this time. This time around, banks are likely to hold much more of the cut back, according to Morgan Stanley bank analyst Richard Wiles. On average, we would expect average standard variable rates to be lowered by 10 to 15 basis points, compared with then better 20 basis points in each of the June and July, Mr. Willis said. The view at JP Morgan is similar, with their bank team arguing about a third of the first cut and half of the second cut will be held back. The squeeze on the ever-diminishing returns from bank deposits is a big part of the bank's problem, and depositors' problem for that matter. Morgan Stanley sees another 0.2 percentage points being lopped off depositors' rates, and that is with more than a third of bank deposits now attracting interest rates less than 0.5%. But at least it's not negative. Not yet. Yeah. The margin pressure from the deposit spread squeeze has been exacerbated by competition from second-tier and non-banks for a greater share of the mortgage market. At the same time, regulators are demanding the banks hold more capital. Loans for new customers are now a lot cheaper than those who've been paying off their mortgages for years. The escalation in price competition on new loans can be seen in some of the offers being made to home buyers at the moment. The big banks have been marketing cashback offers worth a couple of $1,000s, or even a fistful of frequent flyer points, which probably add up to a bit around less than 0.1 percentage point cuts on a $400,000 loan if you could be bothered doing the maths. Political pressure. However, Watermark Funds Management Harry Dudley says the banks will be obliged to pass on a rather more substantial cut, particularly for the first move. It becomes quite political at this stage. It would be a bit audacious not to pass on a decent cut, he said. It is a delicate time for the banks. ANZ, Westpac and NAP rule off their financial year this weekend and report their annual, and likely to be large, profits in November. After the revelations of the Hayne Royal Commission, they are a pretty easy target for a bludgeoning by a posse of politicians eager to prove they're bona fide as champions of the people. I don't think any of them are. I don't think any of the politicians are at this moment. But it'll be interesting to see their profits, guys. What do you think? Let me know in the comments. Do you think the banks will be profitable, or the poor banks struggling? They're struggling, you know. At the same time, they have regulators like the APRA worried about too much easy money flooding back into housing, undermining financial stability. The Reserve Bank has its own issues to balance. It wants the cuts to keep a lid on the currency and stimulate job growth, but simultaneously doesn't want to blow up a fresh debt bubble. See, this is the thing. This is the thing. I'm just going to jump here to Australia, and we'll jump over here. Let's have a look at some interesting figures. So here we go. Government debt to GDP ratio. We'll look at that one. And where is it? Consumer confidence. We'll look at that one. Where is it? I want consumer debt to GDP. Household debt to GDP. We'll look at that. So you can see here at the max data, look at that rise. Okay, that is a very worrying concern, because remember, debt needs to be paid back. It needs to be paid back. Here's government. There you go. Drop down, shot back up. Australian consumer confidence. We'll look at how that's sitting. Oh, it's dropping below 100. Below 100 means reduced confidence. Look at last time it shot down. So these are all things that need to be considered, because remember, borrowing now is just an offset of future spending. So with wages growing as slowly as they are, what impact will this have on the future? What if, do you think there's a risk of another housing bubble, of them pushing a housing bubble again? I mean, if we have a look here, this is some recent data. I'll bring this up. This was foreign investment, and I would say over 90% in 15-16 of new house approvals, building approvals, were foreign sourced income or revenue. That stimulated the economy. The housing sector overheated it. That was the bubble right there. Look at that cool off. Look at that drop off. Now, I hope there isn't enough. Well, I hope the same thing can't happen without this foreign investment shooting it up. But now we have all these other political issues around the world. People are saying that a lot of Hong Kong money may be coming into Australia and stimulating the current jump in house prices. That's another thing to consider as well. Could we see another bubble? Let me know what you think in the comments, guys. So, Mr. Dudley argues the banks have at least the benefit of lower short-term funding costs to help them. The bank bill swap rate has been a major headwind in the 2018 financial year, but now has become a tailwind for the second half of 2019, he said. It's unrealistic to expect them to pass on all of the RBA cut, but 20 basis points would be a substantial cut. So, missed savings. RateC Research Director Sally Tyndall says the banks are likely to be mindful of their shareholders' interests and therefore will find it difficult to pass on a full cut. Banks are juggling the needs of borrowers, savers, and shareholders in an increasingly difficult equation where base saving rates are already only just above zero, Ms. Tyndall said. Ms. Tyndall said the sluggish home lending market hasn't helped in the equation either. That said, wholesale funding pressures have come down significantly over the last 12 months, so it's likely that a few lenders will step up and pass on a full cut, which could see the lowest variable rate drop to below 2.7%. However, it's more likely banks will pass on around 0.5 or 0.2%, which could see the average mortgage holders miss out on about $10 to $20 a month in savings. We can see here, the loan size and the savings per year. So global markets find a new worry. Global markets have endured a pretty underwhelming third quarter, with any gains being modest at best. ASX 200 picked up 1%, US equities rose 1.5%, and Europe was somewhere in between. Emerging markets tumbled 5%, and broader commodities baskets also fell. Precious metals like gold were the big winner, up 7% since the mid-year. Last week started poorly, with worries over weak European manufacturing data and news of the impeachment movements against the US president. I mean, just the impeachment movements against the US president and what's happening with Brexit there. Is it just me, or does it feel like a lot of lefties don't really appreciate the will of the people anymore? Or the establishment doesn't want to accept a popular vote? Oh, well, democracy was a good experiment while it lasted. It's moved from stalling to reverse on Friday, with reports that the Trump administration was considering delisting Chinese companies from the US stock exchanges. Okay, now this is an interesting thing here. I've only started hearing a few things about this, learning about these Chinese companies that are listed on US stock exchanges, and just the some of the dodginess that's going on there. It's really quite interesting. Really quite interesting. Real Vision TV has a few good YouTube episodes on those topics. If you're interested, I'd recommend it. The move is seen as part of a broader plan to limit US investment in Chinese companies, and hardly a pleasant conversation starter at renewed trade negotiations due to start next week. S&P fell 0.5%, while the tech sector's Nasdaq index, heavy with Chinese-linked semiconductor makers, was hit much harder. The ASX looks like weaker lead on Monday's opening. So we've got the housing and retail updates. Local macro calendar is dominated by housing data, but perhaps the most important figures will be Friday's August retail sales. July's sales figures were pretty awful, falling over the month despite the expected impetus from 2 rate cuts and a promise of fat tax returns. Well, yes, that shows you that it's not working. There's only a limited capacity that this can make any impact. Consumer surveys suggest households intend to spend their mini windfalls, but so far there's been little evidence of that. Well, yes, this was the intention of spending that we looked at. And I think people are lying. I think people are lying. I mean, let me know what you think, guys. This time around, the market is expecting sales to pick up by around 0.5% over the month, and that's a very low base. Anything less will be disappointing. So that'll be one to follow. Private sector credit growth is tipped to remain fairly sluggish despite cheaper borrowing costs. However, lending may well have troughed. New lending for property is picked up, but the overall pulse is still likely to be a weak 3% growth over the year. And CoreLogic's National House Price Index expected to show an ongoing recovery, with September expected to see another solid 1% lift in prices, led by Sydney and Melbourne. So here we have the annual dwelling prices. So guys, it's going to be an interesting week of data released. I mean, we'll see if this rate cut will get passed on and to what extent, but it seems to me that everything we're seeing, that none of these strategies are actually having any impact. They're having diminishing returns. And the problem is that if we have, oops, hang on. No, wrong thing. That's consumer price sentiment. We can see where that's going down. But if we have, a official recession, because technically we're not in recession now, there's very limited capacity for monetary policy to influence. The next stage they would have to go will be negative interest rates. And all this is designed to influence you and to force you to spend, to make spending more profitable than saving. So it really flies in the face of common sense, but we're not dealing with common sense anymore. We're dealing with a world where people are gambling on the bond market that things are going to get worse, so they're willing to accept a potential negative yield for the hopes that more people are going to buy in later. So it is definitely a funny time to be around. Let me know how you are preparing for this and what you think is going to happen. I mean, will you be spending this next rate cut? I would bet a carton that none of you would, that you'd all either pay more off your mortgage or use that saving on the mortgage to pay off other debts, pay off that credit card. Anyway, guys, thanks for watching. Like, share, and subscribe. And if you want to help me out with these type of videos and this content I'm producing, I have a Patreon and a Subscribe Star where I appreciate all the support you provide. I even have Amazon referral links. And guys, those tiny amounts I receive, it adds up. It adds up. I appreciate it. It helps pay for the internet, helps pay for the power, helps me justify this crazy hobby to the wife. Oh yeah, I've got to do my YouTube, honey. I've got to do it. Anyway, guys, thanks for watching. Take care, and I'll talk to you later today.